Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
First, I think what we're going to see at the meeting is we get these updated projections, and we expect the Fed to go from 2 cuts this year to 1, and just acknowledge that the economy is holding up.
I mean, you have to think about it. Interest rates affect how we think about money and what we do with it. Do we spend it? Do we save it? Do we invest it? I mean, if you're worried about mortgage rates, then implicitly you're probably a little worried about what the Fed does here, even though mortgage rates are priced on more of a long-term perspective.
I think it's all about trying to generate headlines that appear as though there is domestic investment, regardless of what the president said on the campaign trail. Obviously, this is a complete about-face, and authorizing this merger or acquisition to go into effect is something that I think the Steel Workers Union has been of mixed, at least public expression about, because they know they needed the investment.
It's going to be a little bit of a volatile ride here for consumers. Probably we will see some minor increases in gas prices, probably along with diesel. Airlines also likely to see an increase in jet fuel prices, all of this stemming from oil prices that did surge late last week. Oil prices now have just fallen back below $70, so consumers probably are still likely to see an increase in gas prices related to last Friday's climb.
We got 1 hour to go until the market close. So let's take a look at the major averages here. They're all in the green and perhaps a little counterintuitive. But, you know, as we've talked about before, we don't always see markets react to geopolitical tensions, certainly not in ways we might expect. So the Dow right now up 216 points. That's about 1.5%. The S&P 500 up 0.9, and the Nasdaq Composite up about 1.5% as well. If you look at other sort of related measures here, you actually do see a little bit of selling in the Treasury market, but just a little bit. It's not much of a move here today.
Yeah, it's interesting, Julie, because to your point, I mean, geopolitics are front and center. Israel-Iran war is running red hot. It's dominating the headlines, but it looks like the market is kind of betting here that this is going to stay relatively limited. We did have reports also that Tehran signaling they're open to negotiation. So bottom line, you have stocks higher today. You see oil and gold and the VIX all lower.
Right.
Of course, strategists are always quick to remind us, you know, war is, of course, unpredictable. We really don't know where this is headed exactly, of course. If you're a trader, you're investors, you're trying to think through different wild cards. But bottom line, the market's betting right now that this stays relatively contained, and it just kind of shows you the general resilience of this market here.
Yeah, it does. I mean, and even though you did have that report about Tehran saying it's open to negotiations, there doesn't seem to be, for now, any let up in the actual hostilities, right?
Correct.
Even if talks are going to happen, doesn't change the situation on the ground. But to your point, doesn't seem like the crude oil market is baking in a big disruption in production for right now, or exports from Iran. If you take a look at the groups in the S&P 500, what is moving here, only a few in the red. You got tech that's helping lead with communication services, financials, industrials as well. And speaking to the point of big tech, you see a lot of green on this NASDAQ 100, and the Megs, it hasn't been that often that we've seen this much agreement to the upside in a lot of these stocks, at least not recently. NVIDIA in particular getting close back to a record high.
Yeah, despite those geopolitical headlines, big tech working in the green. Yeah. All right, well, markets digesting the latest geopolitical escalation between Israel and Iran. For more, let's bring in now Venu Krishna, head of U.S. equity strategy at Barclays. Venu, it is good to see you as always. Let's start there, Venu. You know, Julie and I, of course, discussing geopolitics, the Israel-Iran war. It's running red hot right now. I'm curious, how, Venu, are you thinking through that as a market strategist? When clients are asking you, what are you telling them?
Well, I think the first point to note is that, at least in the past few years, the market has tended to ignore geopolitical risk, in good part because it's been very contained. So I think what the market is telling you right now is they do not expect this to escalate. That is where the risk lies. For whatever reason, if it goes out of hand, for example, if the oil infrastructure gets targeted, so that can lead to a problem in terms of pushing up oil prices, which leads into inflation in the US. So there are some secondary and tertiary effects which can take place. But generally speaking, I think I would note that geopolitical risk has flared multiple times, not just with Iran and and Israel. It's happened twice last year, but it was not. The response from Iran has been faster this time, and the scale seems to be higher in terms of where we are right now. So I think it's worth watching, but I would look at it more closely at oil and what it does, and because that does have direct implications for not only global markets, but US equity markets.
Right, of course. I mean, there's no shortage of risk right now, even if perhaps the acuity of the risks has receded to some extent. So you have this happening in Iran. You have tariffs, still another deadline coming.
That's right.
The tax bill making its way through Congress.
That's right.
So overall, as you weigh the balance of these risks, are you advising clients to take some kind of defensive positions in case we see these sort of playing out in a negative way?
Yeah, so I would say one is that the market is pretty close to our price target. So recently we had increased our price target to 6,050, and we are almost in that level. So what that tells me is that in the near term, I think markets can be a little choppy for exactly some of the reasons you mentioned. Tariffs, the fiscal policy situation, and don't forget that 2Q earnings are going to be the first time when some of the tariff impact will be seen. So we have not seen that yet. It doesn't mean it's not going to happen, right? So, but that said, we have been consistent from the beginning of the year in terms of what we like, which is financials first. Second is big tech. Big tech actually, in terms of what we really like and have had most consistently been favorable to for a long period of time, it's big tech. And the third is healthcare, which is kind of defensive, and yet it'll also benefit from any pickup in M&A activity. In the case of financials, a steeper yield curve, a pushback of rate cuts, the relative valuations, and everything else sort of, again, leads us positive. Big tech, the biggest thing is it got derated quite significantly. Even today, they're trading about 4 handles less than where we started at the beginning of the year, so almost 14% lower. On the other hand, their earnings in Q1 were quite stellar. Right? So they posted, 28% plus of earnings growth year over year. Well, the expectation was closer to around 14, 15%, right? So they continue to post very strong numbers. The AI story is picking up momentum, and the focus has shifted back to growth now as compared to, let's say, 4 to 5 weeks ago. So I think we are in a different spot, but the new wrinkle now is geopolitical risk, which wasn't important till recently, but over the last few days it has.
You mentioned big tech earnings, Venu, but more broadly, what are your expectations for corporate profit growth this year?
Yeah, so good question. So we are expecting 6% profit growth this year. Note though that at the beginning of the year we were expecting about 12.5%. We cut it mainly because of tariffs, because we do now believe that tariffs are here to stay. And it's just that we have not felt the direct implications on earnings. But if you paid attention to what companies were telling you in their earnings in Q1, they're talking about margin pressure. So we saw that from retail, from parts of tech hardware, from Medtech and areas like that. Then you heard from companies telling you that they're going to raise prices, industrials and some select part of retail. Then you heard many of them telling you that they are trying to push costs onto their supply chain, which is parts of industrials which have more organized supply chains. You heard some people continue to insist that they continue to work on broadening their manufacturing base away from China. And lastly, you also saw a big pileup in inventories stacking up ahead of an anticipated pickup in tariffs, right? So I think the interesting thing is that's why I'm reasonably comfortable with the earnings growth of 6% at this point in time, which is not bad, but is less than where we started. But what is more important is we do expect the environment to normalize next year as we get past tariffs by the end of the year. So we will know where we're finally settling after all the negotiations. There we expect earnings growth to actually accelerate to about 9%. And that is assuming that we have economic growth moderating but remaining healthy. You have consumption being slightly better than this year and still running a lot weaker than the pre-COVID consumption trends, especially on goods. So in a setup like this, and with some sticky inflation, we still see earnings growing up 9%. So that's not a bad setup, and that's the reason why we think while a lot of people are pointing to the market trading at 22 times being rich, we don't think so. If you look at the history of the last 30 years, when we've had earnings actually in the positive territory, these levels of valuations have actually suggested that you can expect earnings returns to be respectable. In the short term, because we're already there, I do believe there'll be some choppiness given all the risk factors you mentioned.
Well, as you say, I mean, if 60-50 is your target, that means, not just choppiness, but like between now and the end of the year, we might see stocks not really go much of anywhere.
Yeah, I agree. But I think it's good to take a step back and realize that point estimates are not necessarily where the market will settle, right? So if you look at the scenario or distribution, we have an upside case of 6,600, and we have a downside case of 4,500. But the 66
that's a pretty broad spectrum.
But the 6,600 has a much higher probability. So if you think of probabilities, 60% for the base case, 6,050, 35% for the upside case of 6,600. 15% for a shallow recessionary environment, right? So that risk, if you remember, 4 weeks ago went up a lot. It was more than double that risk, what different risk assets were pricing, whether it was credit or equities generally, or equity volatility. And now it's cut back quite significantly. So in that context, it's not bad, but I would say that your point is valid. On a probability-weighted basis, if I look at the scenarios, we still land closer to 6,050 than much higher, right? That's the reason why I feel that the market is likely to be choppy. But when exactly do you engage or disengage is the question. So if you're even a medium-term investor, I know earnings are going to improve next year. I know the world is going to normalize, and some sort of certainty will come. And then we are moving to an environment in which there are going to be more growth policies through tax cuts and some more deregulation. I think the mix overall is quite healthy.
What are your expectations for the Fed, not just this week, but for this year?
Yeah, as a firm, we expect one cut this year, and then I think a couple more next year. And we think they'll remain on hold, partly because economic activity is reasonably robust, especially in the labor market side, right? And inflation prints, especially more recently, have been low on the lower end. But broadly speaking, we do expect inflation to kick up a little bit as the effect of tariffs starts showing up in the markets. So we think the Fed will remain on hold. They're in no hurry to start cutting aggressively, and obviously the risk of raising it right now is relatively low unless you see a big pickup in growth at this point. Yeah.
Venu, thanks for coming in. It's great to see you.
You're welcome.
Appreciate it.
Welcome.
We're just getting started here on Market Domination. Coming up, oil prices slipping on a report that Iran may want to de-escalate the conflict with Israel. We'll discuss the latest moves and what investors need to watch for with an expert on the other side. Stick around, much more Market Domination still to come. Oil slipping on a report that Iran may want to de-escalate the conflict with Israel. Iran signaling it's seeking to de-escalate those hostilities with Israel and negotiate, looking to resume talks over its nuclear programs. All this according to the Wall Street Journal. For more on what this all means for oil, let's get to Short Group Principal Stephen Short. Steve, it's good to see you here. So obviously the oil market very closely following the back and forth there. What we have seen seemingly thus far is not a huge disruption to Iran's production capacity and export capacity. Is that the right way to be reading it here?
That's correct, Julie. It's clear that the Israelis have a strategic mission. They do not want to disrupt Iran's ability to produce and export crude oil. They're playing it from twofold. That is to say, if they had gone after the oil fields, you're going to drive oil prices well above $100. And whatever good faith you have with allies around the world, you run that risk of turning them against you. Two, I think it is Israel's goal for regime change in Tehran. And if you do see that, you would want a new friendly government, an ability to earn export income. So they're not going after the production. So you are correct. There is, and there does not seem to be or will be, a disruption to the flow of crude oil. Israel instead is going after Iran's antiquated refinery system. So that will drive up cost for the Iranian consumer, thereby fomenting further dissent amongst the population that is against the theocracy there, and that's causing more unrest. And hopefully, from everyone's standpoint, sows the seed for regime change in Iran.
Stephen, the key here, correct me if I'm wrong, because you are the guru here, but the key here, is it not, is the Strait of Hormuz, which is still flowing right now. What would it mean, though, if there was a disruption there, Stephen?
That would be a significant disruption. 1/4 of the world's seaborne, waterborne tanker oil that is traded transits the Strait of Hormuz. So that is a threat. Iran has threatened that, but I put that chance at virtually zero. It is mutually destructive for Iran because if they blockade it, that means they can't even sell their own oil. And now that we have the Nimitz carrier group moving into the region, we have the Fifth Fleet already in the region. Any sort of attempt to blockade the Strait of Hormuz, I think would be, if it ever got to that point, would not last. So I think at this point, it's just strictly brinkmanship and rhetoric on the part of Tehran.
So all of this being said, Steve, can oil investors and therefore sort of by ripple effect, equity investors safely maybe not ignore this, but, sort of assume that this is going to be the status quo for the near term unless something dramatic changes?
Well, I think that would be a tremendous mistake to assume that we're going to see the status quo. You have seen something now in the Middle East we've never seen before. Israel has attacked and destroyed most of Iran's nuclear capabilities. Iran, in kind, has yet to succeed, but has attempted to go after Israel's nuclear facilities at its plant in Dimona. So we are looking at, and we are on the cusp, and it is just not Iraq and Iran. It's just not in the Middle East. Let's face it. Let's not be naive. This is an event that goes beyond this is after the West, Europe and the United States. So no, I think it would be highly unwise to ignore what is going on, given that I do think this is the greatest event to royal oil markets, or the potential, therefore, since Iraq's invasion of Kuwait in August of 1990.
So let's put a number on it, Stephen. So oil right now at 71. When you're talking to your clients, they ask you, what is your base case for the second half of the year? What are you telling them, Stephen?
Well, our base case for this quarter, which we only have a couple more weeks left, was a 50% probability that we could finish the quarter above $83 a barrel. We had, going out along the curve in our modeling, our two worst case scenarios were a 2.5% probability we would top $110 a barrel, and a small, albeit still a probability of 0.5% that we could be over $140 a barrel by this summer. Now, factoring in what is potentially we could see right now, certainly $160 oil is within the realm of possibility by the end of this year. But as we've seen today, oddly enough, the market is assuming status quo. This market is trading like it is January 16th, 1991. Now, remember, in August of 1999, Iraq invaded Kuwait. Over the course of the coalition buildup, we saw a 30% increase in oil prices. On January 16th, the eve of the aerial bombardment, the start of Desert Storm, the market peaked and then crashed. And within a week, it was 47% lower than where it was at the start of the war. So the market rightly and correctly predicted that once the war began, it would be short-lived. I'm not so sure we're at that situation. Israel, regardless of the headlines of what Iran is saying, it takes two to dance, and Israel has made it clear they are not going to stop until they've eradicated Iran's nuclear program.
All else being equal, before this happened, what were the dynamics in the market looking like to you? Were we at sort of a fair value for oil prices?
No, we were well below. We were about probably $5 to $6 a barrel. Oil prices for the second quarter have hovered in the high 50s to the low mid 60s, which is a solid $6 to $10 below where they need to be. So if we look at the forward curve, there was a good demand in the market. We were in a sharp backwardation, meaning prices tomorrow were lower than prices today. That is a telltale commodity trading 101 that the fundamentals were telling us they expected demand to outpace supply. But an odd thing was happening when we look at the start of 26. The market had shifted in contango, which is telling you that prices today are cheaper than prices tomorrow. And once again, this is a telltale that the market was anticipating supply would outpace demand. So we were in a short-term bullish market But in the tea leaves, looking out on the forward curve going into 26, it was painting before this a much bearish story.
Steve Short, good to see you. Thanks so much for joining us.
Thank you.
Let's get to some of today's trending tickers. We're watching Advanced Micro Devices, Sarepta Therapeutics, and EchoStar. First up, we've got AMD. It is seeing its share price rise after a price target increase from Piper Sandler, which cited a GPU snapback. The investment bank highlighting enthusiasm about recent product announcements as, quote, pivotal for growth in the GPU industry. Piper Sandler also noting that AMD is working through its China-related issues and its fourth quarter looks promising following Friday's pre-quarter close call. Harsh Kumar, the analyst on this, what's interesting about this, Josh, is AMD did come out with some product announcements last week, and the market was largely unimpressed. And now he comes in and sort of takes another look and kind of level sets, and the market comes back in.
Yeah, I mean, Harsh is enthusiastic. He's positive on what he saw there. I also did see analysts at BNP Paribas cited as saying call AMD held Friday with analysts, they say, sent a reassuring message headed into results next month. You look at the stock, even at the pop today, you know, it's up single digits so far in 2025, but this is one of those names where the street is just overwhelmingly bullish.
Yes, they are. I mean, we've seen it underperformed NVIDIA too, but by a smaller margin than it had been, because NVIDIA hasn't been doing spectacularly well either. All
right, we're also watching Sarepta Therapeutics, seeing shares they're plunging after announcing another death related to one of the company's gene therapy drugs. So stocks under pressure here, Julie. Reported a second patient died of acute liver failure. It sounds like while being treated with this gene therapy for what is a rare muscle disorder. Company did suspend 2025 revenue guidance. I do see analysts at Cantor cited as saying second death is going to dramatically impact physician, caregiver, and patient decisions going forward.
Right. So this disease is called Duchenne muscular dystrophy. About 15,000 Americans have it. It mostly affects young boys and causes muscle wasting because of a lack of a certain kind of protein. There is a very active parent community who has lobbied for years to push forward the development of experimental drugs. And so this drug was approved, even though there were some questions about its efficacy. And now you see the second death. There are now questions about whether the FDA will add some sort of label to it. Analysts seem to be playing down the possibility that the FDA would actually pull its approval for this drug. But nonetheless, it is something to watch very closely, and it's also a very expensive therapy. $3.2 million is what we're talking about here. And then finally, let's talk about EchoStar. It's seeing price hikes today following President Trump's urging to settle an ongoing dispute between the company and the FCC, according to Bloomberg. The company behind Boost Mobile and Dish feuding with the FCC over the company's wireless spectrum licenses. Back in May, the FCC started an investigation into EchoStar's compliance with federal requirements surrounding the construction of a nationwide 5G network. And Bloomberg reporting late Friday that there had been some meetings between Charlie Ergen, who's the head of the company, and President Trump, and then also Brendan Carr of the FCC, and that they're all sort of getting closer to some sort of an agreement.
Yeah, so Bloomberg report, I also did see Bloomberg analysts who follow the name, they were weighing in saying EchoStar may be forced to sell or share its exclusive rights to mobile satellite service spectrum to ease pressure they're talking about from the FCC. They talked about, which is threatening to revoke some licenses. They say Trump is urging resolution, but they were arguing resulting deal could actually favor Starlink, and they say AST Space Mobile disadvantage EchoStar, but you see that stock, we're up about 50%.
Yeah, and one more thing to mention, when you look at how much the stock is up, the company had warned that it might have to file for bankruptcy if it wasn't able to get this deal done. And some analysts are saying that wasn't a financial consideration, it was purely a political one if it wasn't able to get this through. And President Trump reportedly saying he doesn't want a big American company like this to go under. So that was part of what prompted these discussions. So we'll see what happens.
We will. All right. The Federal Reserve, meanwhile, widely expected to hold interest rates steady at its meeting this week, but investors will be watching for something else from Jerome Powell and company. We discuss on the other side when market domination returns.
The Fed's latest round of projections released Wednesday will include the much-studied dot plot. It's a chart updated quarterly that shows each Fed official's prediction about the direction of the central bank's benchmark interest rate. Our next guest, however, is in the camp of no cuts from the Fed for the remainder of the year. We got Kenny Polcari here, a SlateStone Wealth chief market strategist and host of the Yahoo Finance podcast, Trader Talk. So each one of those little dots represents a member of the Fed.
Yes.
Each year where they think rates are going to be.
Yes.
And even Jay Powell himself has said, don't take it as gospel, right?
Right.
It's just sort of the prediction from the members of the Fed at a snapshot in time.
No, and it's like they take a pencil and they literally draw a dot on a graph paper. That's what it is, right? It's not computerized. It's just each person takes a pencil and draws a dot.
Gotta love some analog flavor from the Fed, right?
100%. But to Jay Powell's point, you can't, it isn't gospel. It's just what everybody thinks, right? I'm in the camp that we're not getting any rate cuts the rest of the year.
How?
Because I don't think the hard data suggests that the economy needs a rate cut. I think the hard data continues to be relatively strong and robust, and I don't see any reason that we need to see a rate cut. Look, if they cut rates, they're going to stimulate an already strong economy.
Well, to your point, Kenny, did you see, the Atlanta Fed GDP, I think the latest one is 3.8.
3.8.
You can't cut into that.
Right. We went from -3, where we were going to get quarter over quarter of negative numbers. Okay, how'd that work out, right? And that was only negative because of everyone had that tariff concern, right? So they all but now they have it at 3.8% in the second quarter. So where are you cutting? The economy is very strong.
The president wants them to cut.
Of course, every president wants you to cut. I get it, but I think Trump needs to stay in his lane. I get that if we cut rates, we save about $300 billion in interest costs. Well, okay, I hear you. And if Janet Yellen had refinanced it when it was 1.8%, we would have saved, $1 trillion in interest costs. Right?
What do you think? More near term. This week, are you in the camp that says the messaging, the narrative, the dots, nothing changes?
No, no, because I think there are some people that are I think there's some members on the committee that want to see a rate cut. So I think you'll see some small changes. But I think in the end, Jay Powell's going to say, okay, here's what it is. But this doesn't really mean this is where rates are going. It's what people feel. Right. You feel, he feels, and I feel. But it's only going to be determined really by what happens with the economic data. And at the moment, I think it's strong.
So what does all this mean for the market?
I actually think the market's okay because I think the data's strong, the economy's strong, so I think the market is okay. If you take the
market doesn't need the Fed to cut.
No, I don't think the market needs the Fed to cut at all.
Right.
I don't think it does. Look, we're almost kissing the highs again, right? We're almost kissing the highs. And if you didn't panic on April 2nd and you looked at your portfolio today, you're actually better today than you were on April 2nd.
If I'm at 60.26, walk me through the levels. Where's support? Where's resistance?
So support is way down to 59. I have to look at the chart. I think it's down to 59.97. And resistance is the high that we had 6,100 or 6,086. And that's not even resistance. That's just the all-time high that we have to kind of test and break through. I think kind of we stay between here and there, and we keep testing it. I don't think we're going to go right through it at the moment. I think we're going to find some resistance there, but I don't think, if we trade lower at all, I think we're going to trade down to the support line. I'm not even sure we're going to go there. But if we back off again, that's where I think we'd find great support.
61.44, by
61.44.
61.44.15 was the closing high, to be specific.
Right. Okay. So that would be that's not even resistance. That's just the prior high, right? We're above all three trend lines. So the resistance is going to be. You just have to look at the chart and kind of follow it. But that would be the next level that you want to test.
Gotcha. All right, Kenny, the man in black. Always good to see you, my friend.
Johnny Cash.
I was going to say one day we got to get him in here with the guitar.
Right. Thank you, Kenny. Meanwhile, the European Union weighing a 10% tariff deal as President Trump's July deadline now looms. For more on what this means for car makers, let's get to our senior autos reporter, Pras Subramanian. Pras.
Yeah, this is kind of a big deal for European automakers like BMW and Mercedes. To bring that down, that sector tariffs of 25% to 10% would be a huge deal for them, based on the fact that so many of their cars are sold here. But the UK has a deal already, supposedly with the US, and I spoke to the Bentley CEO about this, and they said, hold on. There's actually no details yet. The deal has supposedly been agreed to, but The UK government is still waiting for paperwork and actual deal terms from the US government, and UK government said it might take a few weeks still. So I spoke to the CEO about this, and he said basically, since we don't have the deal actually, the terms yet and signed.
So he's saying, I don't know. He's saying, I just have a world of uncertainty I'm navigating.
Yeah, so exactly, because they last month they made the announcement, but the deal hasn't been signed yet or come through yet. So he told me a few things that they're doing. Basically, they're working month to month here on policy, price protecting through the month of June. People who have custom orders in place, they will honor those pricing agreements, and they'll bring the cars in. But further inventory is going to be held in the UK until further notice, and basically they just can't bring those vehicles in until they know what their exposure is going to be, because it could be a lot more, it could be a lot less, who knows. So keeping it there. They won't make any more decisions until next month. So month to month they'll keep announcing that. But they also have a new car out, new Bentayga Speed. This SUVs are top selling SUV. They made the Speed version is a V8 powered truck.
How much is that going to run?
Yes, that's my big question.
Around $300,000 probably, but it's going to be only gas powered. Which is a change for them, because they've been going heavily into hybrid. But they say, hey, you know what? Our buyers want this option, and it'll be a very special car, so they're going to do it.
I would assume that Bentley has a decent amount of pricing power at that level of customer, that if they do end up, if they get more clarity around the effect of the tariffs, that's going to increase their costs, that they can pretty easily pass that on to their customers, or?
I mean, 10% is not that big of a jump from, like, say 25. So a $300,000 car, you're talking about $30,000. So how much of that is going to go to the client and versus them? Half, more than half. Right. I think that's part of the question they have to sort of answer themselves. But yeah, I think you're right. I think it's not a fully inelastic good, right? There is some ability to kind of waver here with pricing, but they can't go too far, right? Because margins are, I think the last year they were around 14%, right? So there's only so much you can play with, and that's been coming down from 20 the year before. So that's the big question.
Even if you're rich, you still want to feel like you're getting a good deal.
Well, that's why you have all the money. You don't pay when you don't need to.
There you go. All right, thanks so much, Pras. Appreciate it. Coming up, a closer look into the cautious optimism in the travel sector and the best way to navigate turbulence in that industry. More market domination on the other side.
Well, travel hitting a turbulent patch amid macro uncertainty. However, cautious optimism creeping in for one area in the leisure landscape. We're looking at how to play the trends in the lodging industry in our investor playbook. Macquarie U.S. Equity Research Lodging and Theaters analyst Chad Bynan joins us now to discuss. Chad, always good to see and have you on the show. Maybe start big picture, Chad. You look at that travel industry, at least based on your coverage universe, Chad. You know, you're reading through those earnings reports, you're listening to calls, doing your checks. How would you kind of generally characterize the travel industry right now, Chad? You know, is it healthy? Is it resilient? Showing cracks? What are you telling clients?
Sure. Thanks, Josh. Yeah, so it's been about 4 months, right around Liberation Day, where we've seen a pause in terms of forward bookings. Now, usually when you think about leisure travel, people thinking about spring breaks, vacations, future travel, it's at least 30 days out. So what we're seeing is that 30-day booking period has kind of come down closer to 20 days. So as we get closer to that date, people are booking last minute, but they're not booking as far as ahead as they would have in the past. And also, when we think about chain scales, luxury is holding up. So people with that disposable income continue to prioritize travel over things. But we are seeing some weakness at that low end. And then lastly, I would say, obviously the continuation of a weaker dollar and, just some of the impacts towards Mexico and Canada. Some of the inbound tourism it continues to remain weak, probably for the last 3 or 4 months.
Chad, I want to dig into that last point a little bit. I mean, I keep seeing headlines, at least anecdotal evidence. I think the latest one was about Old Orchard Beach, Maine. They used to see a huge influx every summer of Canadians, and some of those people, at least, are not coming. How important is that for U.S. hotel chains? I mean, I realize that many of them have international holdings as well. But in terms of hotels in the U.S., how important a factor is those international travelers?
Across the country, it's low to mid single digits. So I would say 3 to 5%. But to your point, there are certain resorts and gateway cities that are going to have a higher percentage. But yeah, as we blend it, it's a lower percentage. What we're also probably going to benefit from this year is fewer outbound travels. I think the last 2 years, it was the time period where a lot of Americans were registering their passports, maybe for the first time, or using it for the first time in a while, and traveling abroad. Now there's going to be more of those closer to home or domestic destination holidays. But yes, I absolutely expect for inbound, which are longer stays, to be down this summer through the rest of 2025.
Chad, let's talk about some picks. Your top lodging pick would be Hyatt. Now that stock is down. It's in the red this year and over the past 12 months. You say this one is a buy, Chad. How come?
Sure. This is one that has had the journey of going asset light. So the reason why Marriott and Hilton, really the best blue chip stocks in the lodging industry, trade at 25 times earnings is because of their business model. It's a franchise and managed business model. They don't really have to put in much capital expenditure, and it's really just the reservation system, the branding, and the overall ecosystem that they've created that has warranted that higher valuation. Hyatt is in the fifth or sixth inning of this journey. They continue to sell assets to lodging real estate companies that want to own the asset, and then Hyatt will manage that property from them for a fee. As that happens, we expect for the multiple to increase. So that's reason number one. The second reason is I think they have continued to focus more on the wellness and luxury customer, particularly here in North America. So they skew more higher end versus some of the other portfolios that go across each area. That's reason number two. And then the third reason is to the point that you just highlighted here. It's been a little bit of an underperformer. This was an outperformer in 22, 23, in the first half of 24. But because of some of those reasons, I think it's been put in the penalty box where the fundamentals actually appear to be pretty strong. And they have the biggest pipeline of new properties compared to the others.
So, Chad, you mentioned Marriott and Hilton as already having converted to that model and trading at a higher multiple as a result. You're neutral on those two names. Is it because they've already sort of captured that upside and there's not as much of a catalyst there?
It is. I think from a valuation standpoint, these two will continue to be at the higher end of gaming, lodging, leisure, travel multiples, which have obviously, compressed over the past year or 2-year period. I think from a fundamental standpoint, really what we would need to see for these companies is just a resurgence in the travel fundamentals. I think Hyatt can continue to work here if we're in this kind of wait and see approach, just because of some of the other catalysts that they have. They're also looking to close an acquisition here in the next week or two for a Caribbean Mexican all-inclusive company that they acquired for a little over $1 billion. So they have more meaningful one-off type of impact opportunities. We still love the Marriott and Hilton business model, their management teams, their portfolio, but we're just waiting for a better entry point.
Chad, thanks so much. Great to see you.
Thank you. Appreciate it. You too.
Leaders in healthcare providing a gauge on future strategies in the sector at the Goldman Sachs 46th Annual Global Healthcare Conference. One area that's seen substantial development is the medical technology landscape. Our next guest remains constructive on that industry in broad strokes. Goldman Sachs' head of U.S. Medtech and Healthcare Information Tech Research, David Roman, is joining us now to discuss. David, thanks so much for joining us. So as you had the chance to talk to folks in the medtech industry here, it seems like one of the biggest headwinds this year has been concern over tariffs, right? And the fact that at least some of this stuff gets made in China and other areas abroad and imported here to the U.S. So I'd love to start there and get your take on what you're hearing from these companies.
Excellent. Thank you for having me today. So you're right. Tariffs has been a major concern for investors that did drive companies to lower their outlooks for 2025 on most recent earnings calls. If you listen to the first quarter earnings calls, most companies did take reductions reflecting the then in place tariffs. If you look at medtech, though, in context, about 70% of medical devices sold in the U.S. are actually made in the U.S. This is a significant amount of onshore manufacturing. And unlike some other parts of healthcare, where you do see the move of IP around the world to manage effective tax rates, medtech R&D is very heavily domiciled in the U.S. So as we reflect on kind of where tariff policy sits today, we actually expect fairly significant upward revisions in earnings estimates as we go through second quarter earnings to take into account what are obviously tariff rates that are moderated, especially on China, from what we saw during the April earnings season.
Those supply chain stats are interesting, David. Has it always been like that, or has there been a shift in the last 5 or 10 years in that industry?
So it's actually been a pretty long-standing strategy for medtech companies to manufacture where they sell, and I think it's a good point because that trend did accelerate during the first Trump administration when tariffs went into place. But remember, the medical device industry is very much a manufacturing industry, so things like freight and logistics costs do go into the calculation when companies think about where to put manufacturing. It also allows them to compete locally. So, for example, most companies, take GE Healthcare, who has about 12% of their revenue in China. Something like 70 to 80% of what they sell in China is manufactured and sourced locally. And that puts them in a position to be able to compete effectively with companies who are domestically headquartered there. The same is true in the US. Companies try to put manufacturing very close to where they do R&D. And the reason for that is rapid prototyping and trying to accelerate the development of products. Because this is very much a iterative industry, putting product development and manufacturing closely aligned to one another has actually been a competitive advantage for several companies.
David, what do you think is the sort of most specific product or area of development that's most exciting to you in medtech, and what company or companies do you think are most taking advantage of that?
Yeah, there are a few key themes actually that we think are going to dominate the sector here on a go-forward basis. One is robotics and the continuous move toward eventually what we think will be autonomous surgery, although admittedly we're quite some ways away from that. The second is early intervention, and this has been a theme that's been talked about quite a bit. The whole premise of diagnosing patients earlier in their disease in disease continuum to bring in interventions earlier to improve outcomes. Those two themes we think will continue to dominate the sector on a go-forward basis. And the third is a continued move toward minimally invasive procedures that allow for patients to be treated with things like hip or knee implants and actually go home the same day through the advent of robotics. As we think about the landscape here from a company perspective, we continue to be very positive on Intuitive Surgical, ISRG. The stock did have a correction earlier in the month. There are very few opportunities to buy this company. So we think a pullback represents a meaningful opportunity to buy a structural winner here who does lead in surgical robotics. We think that will continue to be the case. As I think about the kind of whole theme of early intervention, we do like continuous glucose monitoring leader Dexcom. It's a pure play in the space. They have started as a company really focused on type 1 diabetics and have moved into type 2 and just this year launched the consumer segment. And certainly we see CGM or continuous glucose monitoring as one of the primary technologies that has the potential to bend the curve here on healthcare costs and drive earlier diagnosis and earlier intervention.
So, David, I'm curious on that front. I know that you have a sell rating on Medronic. Medronic recently said it was going to spin off its division that had a product like you're describing, that continuous glucose monitoring device. Is that part of the reason that you're negative on the stock, or are there other reasons?
So our thesis on Medronic has really been tied to a view that the company would struggle to generate meaningful earnings leverage. So the way we look at earnings leverage is, can they grow earnings faster than they grow sales? And Medtronic has faced pretty meaningful gross margin compression the past several years. And the stock has rebounded here on optimism around a turn in new product momentum. But as we look at their FY 2026 guidance, the company has targeted 5% revenue growth and 4% earnings growth before the impact of tariffs. And we think that reflects the company's constrained operating margin opportunity. And our view has been that earnings leverage will be constrained here, driving downside in the stock.
David, as you know, there is no trend that investors, of course, are more interested and curious and excited about than the trend and theme of AI. How is the sector you cover, MedTech, how are they leveraging that technology, David, already? And what are some of the benefits and potential risks investors need to think about?
So AI clearly has gotten a ton of attention across the entire market. And in healthcare specifically, one of the things that you've seen is companies really trying to figure out what is the clear use case of AI in healthcare, and whether that's drug development, or is it going to be around consumer facing? Is it going to be about helping hospitals process patients more efficiently and drive better outcomes? Within medtech, what we've seen, and we would argue this is one of the sectors that has the potential to see meaningful benefit from artificial intelligence. There are two ways that we've seen AI impact the sector. One is as an enabling technology. So one example I'll give you is patients go in to have some sort of imaging procedure, whether that's X-ray, MRI, or CT. Imaging centers run a very significant backlog. If you call today to try to get an appointment to have a CT scan on a prescription, you will wait months and months and months. And one of the opportunities of AI is really to help improve efficiency and the turnaround time for reading scans. The other thing that occurs, unfortunately, in some imaging procedures is you're given a diagnosis to have an X-ray of a specific area of the body, and actually, because the X-ray tech is trying to move through so many patients, they actually don't capture the correct image, and that causes some inefficiencies because the patient then has to come back at a later date for re-diagnosis. What AI has done here in a product that GE Healthcare has launched is basically created a kind of green-red, have you captured the image properly? And they do this through the significant amount of data they've been able to capture to ensure that you're getting the right diagnosis at the right time.
David, great to see you and great to have you on the show today. Thanks so much for your time. Appreciate it.
Thanks for having me on.
And while wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.